Today I will seek to make 3 points. First, I will outline the essential role that the resources and the energy sector plays in our domestic economy. Second, I will point to growing sources of demand, explain their relevance to Australia and why it gives us optimism for the future. And third, I will highlight areas in need of attention, in particular the application of geoscience technology to exploration and development, and the need for greater labour market flexibility. These government-led reforms, together with the industry's own efforts, will ensure that the resources sector remains a stable and reliable supplier of high-quality resources extracted at the low end of the global cost curve. Resources is to Australia what the baggy green is to Australian sport. Totemic, iconic, indispensable to our national story and synonymous with our national identity. But frankly, it goes beyond that. The Australian resources sector has helped lift millions of people out of poverty and improve the lives of many more. It is essential for infrastructure and economic development and enhances Australia's strategic importance throughout the world. This is not lofty rhetoric, but observable facts over a long period of time. The case for maintaining a strong and vibrant resources sector is as compelling today as it has ever been. By tracing the history of mining and energy development in this country, one can see how we turned from a series of struggling, underdeveloped and underpopulated colonies in the early 19th century to a prosperous, cohesive Commonwealth that has continued to successfully navigate its way through choppy international economic waters in this century and last. For Australia, it all started with gold. Discovered in Bathurst, New South Wales in 1851, the gold rush precipitated a doubling of Australia's population to 1.1 million people by 1860 and a five-fold increase in the population of Victoria over the same period. On a GDP per capita basis, Australians were the richest people in the world, with Melbourne by 1852 the busiest port in the world. But Victoria was not the only colony to prosper from the mineral wealth under the ground. Copper was discovered in South Australia in the 1840s, gold in Queensland in the 1860s, tin in Tasmania in the 1870s, and gold again, this time in Western Australia in the 1890s, which at the time had a smaller population than Tasmania. As Geoffrey Blaney has pointed out, not surprisingly, the career paths of our early Prime Ministers were all inextricably linked to the resources sector. Among them, Andrew Fisher was a coal miner, Joseph Cook a coal weigher, Alfred Deakin represented the gold district of Ballarat, and Stanley Melbourne Bruce's business prospered, catering to the needs of those on the goldfields. Later, leaders state and federal, like Charles Court and Robert Menzies, made their mark, encouraging the development of the Pilbara, reaching out to Japanese investors, and in the case of the Menzies government, lifting in 1960 the embargo on iron ore exports, which had been a pre-war legacy of Joseph Lyons. But the success of the Australian resources sector must not simply be seen as a historical footnote in a day-long past. Rather, it is a living, breathing, modern success story driving the Australian economy forward, even at times of market turmoil and lower commodity prices. Never was this better illustrated than during the global financial crisis. Business investment in Australia grew by 5% between 2007 and 2009 as the global financial crisis unfolded. This compares to falls of almost 17% in the United Kingdom and a fall of over 11% in the United States, as both countries plunged into deep recessions. The growth in Australian business investment was largely fuelled by a lower exchange rate and demand from China. Preparedness met opportunity at this critical juncture. Today, the resources sector, in which I will include energy as well as minerals, represents more than 10% of GDP and employs over 300,000 Australians. As a sector, it has the largest proportion of Indigenous employees in the nation. It pays the highest wages and employs a large number of skilled workers such as engineers, geologists, surveyors and young apprentices. While historically it was a male-dominated industry, that too has changed. The number of women at managerial level positions has increased by 40% over the last 8 years, and industry leaders like Gina Reinhardt and Catherine Tanner are leading important Australian companies. I know there are many others like them rising through the ranks. The taxes and the royalties that have subsequently been paid by the resources industry are simply enormous. In the decade to 2014-15, the Minerals Council estimates that the sector paid approximately $165 billion in taxes and royalties. This is more than the public health spending in 2014-15 and more than what was spent on education, including schools and universities. In the years ahead to 2040, the LNG projects in WA alone, Wheatstone, Pluto, Gorgon and the North West Shelf are expected to contribute $160 billion in taxes and royalties. This revenue flow is just part of the economic dividend that comes from being the #1 exporter of iron ore in the world, the #1 exporter of coal in the world, the #1 exporter by 2020 of LNG in the world, having the largest known reserves of uranium in the world, and being in the world's top 5 for deposits of copper, gold, bauxite, lead, nickel, zinc and lithium. We are truly a global powerhouse when it comes to the resources and energy sector. Australia is among the greatest beneficiaries of Chinese growth and the continuing demand from our major and long-standing customers in Japan, Korea and the ASEAN countries. In September 2011, our terms of trade reached its highest level in 140 years, and the prices of iron ore and coal, our 2 largest exports, more than doubled in the decade to 2014. In the same period, investment in the resources sector topped $400 billion, and the contribution of the sector to the Australian economy jumped from 8 to 13% of GDP. While the impact of this growth was most notable in the resource states of Western Australia and Queensland, the whole of the country did benefit. The Reserve Bank of Australia says that as a result of the mining boom, which they describe as one of the largest economic shocks in our nation's history, by 2013, wages grew by 6% more than they otherwise would have done, while household spending was 11% higher, equal to over $100 per week for the average Australian household. But now we have reached the end of a decade-long supercycle, which saw record prices fuelled by record demand. We are now seeing more normalised cyclical patterns of demand, particularly in China, as its economic growth moves from double digits to settle around 6 to 7%, and its economy transitions from investment to consumption and a greater focus on services. China remains central to the global resources story. It is the world's largest producer and consumer of coal, the largest consumer of iron ore and producer of steel, and the second largest consumer of oil and the third largest consumer of gas. China, importantly, is also increasing its reliance on renewables, becoming the largest investor in renewables in the world, bigger, according to the IEA, than the EU and the United States combined. But today I want to dispel the fallacy that because the Chinese economy is transitioning, that suddenly the demand for our hard commodities and the subsequent export income we earn will dry up. To paraphrase Mark Twain, the reports of the death of the resources sector is greatly over-exaggerated. International demand for Australian resources remains strong, our companies remain resilient, and the depreciation of our dollar has acted as an automatic stabiliser, increasing our competitiveness. The reality is that over the decades ahead, hundreds of billions of dollars will flow to Australia as both demand and supply increases. A good illustration of this dynamic is Australia's export earnings from coal and iron ore between 11-12 and 2014-15. Despite falls of 43% and 50% in terms of prices, export earnings from these commodities fell only 16%. This reflects the lower Australian dollar and a 30% increase in coal export volumes and a 60% increase in iron ore export volumes. Fancy this. For every 1 cent movement of the Australian dollar against the US dollar, it changes our export income from energy and resources by $2 billion. When it comes to LNG, there is even a more powerful story to tell. Export earnings between 2011 and 2012 and 2014, 2015 have increased by more than 40% and driven by increased volumes and a lower Australian dollar. Export earnings are expected by 2019-20 to almost triple to $49 billion. So LNG export earnings will nearly triple to $49 billion. Indeed, by 2019-20, my department's chief economist expects resources and energy export earnings to total $235 billion compared to $172 billion today. So where is this demand coming from, and why is the Australian sector so resilient? Let's look at the Chinese economy first. At $11.4 trillion in US dollars, it's 2.5 times bigger than it was in 2008. Again, as the Minerals Council has pointed out, this means that a 6.8% annualised growth in 2015 is equivalent to 14.2% growth in 2007. This emphasises how important it is to avoid drawing conclusions from simplistic comparisons of annualised growth rates. Remarkably, each year, the Chinese economy adds an economy the size of Turkey. So, for example, in December 2015, China imported more iron ore than ever before. Some is used for the production of steel for export and the rest for domestic use. Chinese steel exports to the emerging economies are growing, with steel exports in 2015 increasing by 26% to India and 55% to Vietnam. And while China has seen rapid rates of industrialisation in recent years, leading to more than 200 million people moving to the cities, 37,000 kilometres of rail track and 63 million flats completed in the last decade alone, there is still a long way to go. For a country with such a large landmass and population, its rail system is 1/3 of the size of the United States and 1/6 of the size of the EU. That seems to provide a lot of scope for Australia's iron ore and metallurgical coal. When it comes to energy demand, China's per capita consumption is still 1/3 of that in the United States, an equation that the IEA predicts will change dramatically as Chinese per capita energy use increases in the years ahead. But I want to emphasise today that China is not the only game in town. Economic growth in India, as well as that in Southeast Asia, is driving increased demand for Australia's resource exports. In 2015, India's economy grew by 7.4%, and there is an expectation of growth of 6.5% a year from now to 2020. On the numbers, the Indian economy will be 5 times bigger in 2040 than it is today, and as a result, demand for coal, gas, iron ore and renewables is taking off. Consider this. Today, India has 18% of the world's population, but represents only 6% of the global energy use. Astonishingly, on a per capita basis, it is lower in India than it is in Africa in terms of per capita energy use. Around 300 million Indians have little access to electricity or no access at all. But by 2022, Prime Minister Modi wants to connect every Indian to the grid. India's consumption of steel is also comparatively low. On a per capita basis, it's 1/4 of the global average and about 1/8 of what it is in China. With over 300 million Indians expected to move to the cities by 2040, demand is soon to escalate. All this is good news for Australia. Contracts for our LNG from our Gorgon project to Petronet LNG have been signed and are soon to flow, and our coal exports to India, already worth $5 billion a year, are set to increase. As India's Minister for Power, Coal and Renewable Energy, Piyush Goyal, said in Australia last week, we will be expanding our coal-based thermal power. That is our base load power. By 2020, India overtakes Japan, China and the EU to become the largest importer of coal in the world, and it seeks to almost treble coal-fired power generation between now and 2040. Goyal, again, he said, the people of India want a certain way of life. They want jobs for their children, schools and colleges, hospitals with uninterrupted power. This needs a very large amount of baseload power, and this can only come from coal. Notwithstanding this, it is important to note that the global demand for coal is falling as a percentage of the overall energy mix from 40% today to 30% in 2040. This is on the back of a significant decline in OECD countries that is not fully offset by what is happening in Asia. While absolute demand for energy in the OECD is declining, due in large part to greater energy efficiency, demand for energy in Asia is rising, notwithstanding the utilisation of greater energy efficiency there as well. And this is because of the dramatic increases in population, urbanisation and rising middle classes in our region. The global demand for gas will increase by 50% between now and 2040, and as we are soon to be the largest exporter of LNG in the world, this will make Australia the greatest beneficiary. I can hear the questions from the audience already. Isn't India focusing more on renewables, making the coal the energy of yesterday and soul the energy of tomorrow? The answer is much more complex than that. India is making huge investments in renewables, aiming to double its capacity between 2014 and 2022, and China has, according to the IEA, as I said, invested more in renewables than the US and EU combined. Indeed, half of all new capital invested in the energy sector in 2014 was in renewables. But even with these investments, by 2040, the IEA still expects that renewables will only constitute the source for 34% of global energy requirements. Of course, new innovative technologies such as battery storage could enhance these ratios, and as a government, we support such efforts. But given the cost of capital and the long-term planning required for energy projects, we also have to work on the energy mix assumptions that we have at our disposal today. This means that there will be a significant role for fossil fuels even post the important and historic agreement adopted by more than the 180 nations in Paris last year. The reality is that there will be a significant demand for our energy and minerals going forward, and this does form the basis for long-term optimism for these sectors in the Australian industry. And it's simply a consequence of arithmetic. Between 2010 and 2030, there will be major increases in the world's population by 23%, the world's urban population by 42%, and the world's middle class by 100%. All of this fuels the demand for hard commodities, and the biggest movements are occurring in emerging economies right on our doorstep, putting us in an ideal position to capitalise. But we simply cannot be complacent. And now I want to talk about a couple of reform ideas. Because if we continue with our reform program and build on our reputation as a reliable, efficient supplier of high-quality product, we will stand to benefit. And a key here will be science and innovation. Already companies like BHP, Rio and Fortescue have taken the lead in automation, operating drilling equipment, trucks and trains at their mines in the Pilbara remotely from their Perth headquarters some 1,500 kilometres away. These steps have delivered productivity gains to the companies in order of 10% and help ensure that 3/4 of Australia's iron ore production is on the bottom half of the global cost curve. But in addition to these private sector-led initiatives, there is much the government can do to leverage off its existing scientific expertise and databases to enhance the production of exploration and of activity. For example, Geoscience Australia has the technical capacity to undertake geological mapping of mineral deposits both near the surface and to depths down hundreds of metres. This can be of great assistance to companies who cannot afford mapping on such a large scale in search of the next Tier 1 deposit. I'm currently consulting with industry on a range of new measures that could help de-risk exploration in Australia and enhance our competitiveness. With pressures on company balance sheets leading to a significant decline in exploration activity, there is no better time for the government to undertake such a program. Previously, government assistance in these areas has had a major multiplier effect. For example, in 1996, Geoscience Australia undertook $3 million worth of work in the Browse Basin, the information from which facilitated the discovery of the Ichthys field, which will lead to more than $70 billion in export earnings over the next 40 years. Similar success has been achieved by federal and state agencies with their work at the Olympic Dam site and in the Bight Basin. Indeed, it's been estimated by an independent Western Australian study that the rate of return for every dollar invested in pre-competitive programs has a multiplier of more than 20 times. Another area where there is both an opportunity and a need for reform is in the industrial relations space. Now more than ever, Australian projects need to deliver productivity gains if they are to remain competitive. We need to leave the mindset of capital versus labour behind, as both the worker and the investor benefit and gain from greater productivity, which in turn encourages greater investment. As a Western Australian and the Minister responsible for employment, my colleague and friend Michaelia Cash knows this very well. The re-establishment of the Australian Building and Construction Commission is vitally important to the resources sector, and so too are reforms to union right of entry rules and greenfield agreements. With regard to the right of entry, it is our policy to restore some balance to a process which has seen unions exploit the law to make, in some cases, hundreds of site visits over a short period of time. Reducing the frequency of visits by union officials to premises where they have no members or they are not invited to send a representative would be a positive step forward. With regard to greenfield sites, the Parliament, with the assistance of members of the crossbench, passed important legislation last November which allowed employers to go to the Fair Work Commission after a 6-month negotiation period had passed without agreement between them and the union. This was an important amendment that will prevent negotiating tactics dragging out indefinitely. A further matter which is important to the resources sector, which has been raised with me, relates to extending the duration of the greenfield agreements to the duration of the construction period of a particular project. Otherwise, you have a situation like we've seen at the $70 billion Gorgon project, where the completion of billions of dollars worth of investment can be delayed while protracted and difficult negotiations take place. This is an essential and unnecessary risk that companies have to factor into their investment decisions, which does deserve further policy consideration. Ladies and gentlemen, the resources and the energy sector has been here before. Peaks and troughs are part of a cycle reflecting complex supply and demand dynamics. This is a long-term business, and Australians should be proud of the role that their sector plays. The good news for the Australian resources and energy sector is that we have the economies of scale, the innovative practices, the highly skilled workforce, the proximity and access to markets that gives us the resilience that we need at this important time. There is no room, however, for complacency. We are operating in a fiercely competitive global market. We need the right domestic policy settings if we are going to seize the investment needed to meet the next wave of demand which is coming out of our region. For these reasons and many more, there has never been a more exciting time to be the Minister for Resources, Energy and Northern Australia. Thank you very much.